This is Horizon's Middle East and Africa, our top stories this Friday morning. Israeli Prime Minister Benjamin Netayahu says the country is prepared to stand alone if need be. That after the U.S. withheld an arms shipment and warns of more halts. Asian stocks rising after an upbeat day on Wall Street, with U.S. jobs data supporting the case for Fed rate cuts this year. And a Bloomberg scoop. The U.S. is set to impose tariffs on Chinese EVs and strategic sectors as soon as next week. Well, it's just gone 8 a.m. across the Emirates. I'm Joumanna Bercetche in Dubai. Good morning to you. Happy Friday. Let's get a check on how these markets are faring. S&P above 5,200. We finally broke through to the upside. The close was 0.5 percentage point higher. We're about 1% away from those all-time highs, of course, as the market continues to center in around this narrative of rate cuts coming sooner this year. 10-year yield sitting at 4.46%. We saw a bit of a bounce after better than expected 30-year auction, coming 1 basis point through yesterday in the trading session. Brent also in focus, sitting above $84 now, a third positive day in a row. We actually are broken through the 100-day moving average to the upside as we get into that OPEC meeting in a couple of weeks' time. And then the pound also in focus. You can see dipping a little bit, but of course, lots of fireworks after that more dovish than expected Bank of England monetary policy decision yesterday. We will talk more about that on the show. But I just want to take you to one piece of information that we got out of the U.S. yesterday. Significant data, and you can see the U.S. initial jobless claims. Look at that yellow spike at the end of that chart. That tells you what an anomaly yesterday's numbers were. Actually, the highest jobless claims number we've seen since last August, telling you that that weakness in the labor market is beginning to gain more ground, and one of the reasons why the market has started to bring forward the timing of that first rate cut. But of course, it's not just the U.S. we're focused on. As ever, we're going to check on how these markets in Asia are faring. Avril, what is on your agenda today?
Yeah, Joumanna, we're seeing Asia stocks tracking Wall Street's performance after that spike in U.S. jobless claims, boosting these bets that we're going to see Fed rate cuts this year. On the Hang Seng, it's getting added fuel by reports that regulators there are considering the proposal for a dividend tax waiver. So that's lifting financial stocks in the city. That being said, U.S.-China tensions seem to be weighing on some of these Asian equities, and the stock gauge is actually pulling away from session highs. We're also seeing Chinese EV makers coming under pressure against the backdrop of that Bloomberg scoop that we could see these tariffs, fresh tariffs for Chinese EVs, battery makers, even solar equipment makers. Let's flip the board and take a look at how that's playing out in the FX space. We're seeing offshore and onshore yuan both weaker. We have the likes of Maybank flagging that the gap could widen between them as there's U.S.-China tensions in an election year that might not be going away so soon. We're also seeing the Aussie dollar really coming badly hit today as well. Joumanna.
Excellent for that overview, Avril. And of course, a lot of that is going to be determined, the direction from here is going to be determined by what U.S. President Biden decides to do with those tariffs, potentially hitting some strategic sectors in China. So something to watch out for. We will talk more about that on the show as well today. But going back to geopolitics, Israeli Prime Minister Benjamin Netayahu is striking a defiant tone against President Biden after the U.S. withheld a shipment of bombs ahead of a looming offensive in Rafah. Speaking to American talk show host Dr. Phil, Netanyahu called Washington's delay in arms shipments a mistake.
I've said in the Holocaust memorial service that we had the other day, I said in the Holocaust we stood alone, but we were defenseless. And today, if Israel has to stand alone, we'll stand alone.
Well, for more on this, let's bring in senior editor Bill Ferries. I think it's pretty clear at this point that Israeli leaders, Netanyahu himself, the prime minister, are very frustrated with the U.S. decision to withhold those shipments ahead of a potential offensive into Rafah. What do we read from those comments out of the prime minister overnight?
Well, it's, the latest sign of the real friction in this relationship. The U.S. Would like to see Israel and Hamas get closer to some sort of even a temporary ceasefire. It's very rare to see this kind of public divide between Washington and Israel. So even historically, that's very unusual. It should be, there's also a degree of politics going on here, of course, public politics. The U.S. is withholding some of these weapons, but has made clear that it will continue to supply defensive material for things like the Iron Dome network. And it is not, at this point, holding off on other shipments of weapons, and that includes the $4 billion package that was recently approved by Congress and the White House. But this divide it's very tense. It's widening. The U.S. is trying to put all the leverage it can on Israel to not go forward with a massive ground invasion of Rafah.
Yeah, absolutely. The U.S. are trying to restrain Israel, and at the same time, it is posing a bit of friction in the relationship. I thought it was also interesting in that conversation with Dr. Phil that the Prime Minister Netanyahu did make some comments to the effect of how important the relationship is with the U.S., and not just with the U.S., but also with President Biden himself. Let's listen into what he said.
I've known Joe Biden for many years, so 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country.
So, Bill, here he was drawing in on his personal relationship with President Joe Biden. And in essence, what we're seeing is not a break in the relationship, but more, as you pointed out, the U.S. trying to exercise some caution, trying to restrain the Israeli response and the potential offensive that could happen in Rafah.
Right. There's very much a public diplomacy aspect to all of this, and there's also the behind-the-scenes talks. I think, the U.S. has made its frustrations with Israel very clear. They've wanted to draw this line on Rafah, but they have not opposed some of the early moves that we've seen Israel making in Rafah. They've said that the kind of more strategic strikes that have taken place so far are within the scope of what the U.S. thinks is acceptable. So it's a very fine line, and things could easily spiral out of control. But the U.S. focus remains on preventing a greater humanitarian disaster in Rafah and southern Gaza, and trying to get these two sides to at least agree to this ceasefire plan that has been in the works for months now, in which it seems both sides are very close to agreeing to, except for some key sticking points.
Yeah, and obviously that is the main question looming in the background. Another story that came out this morning, this is per Axios reporting. Blinken, the Secretary of State, is planning on submitting Israel conduct report to Congress as soon as Friday, so that's today. Axios has cited 3 unnamed U.S. officials on Blinken's report. The report won't say Israel broke weapon use terms per Axios reporting. Of course, this is not our own reporting, but I think it is interesting in the context of the friction between the U.S. and Israel right now that this report is actually being submitted to Congress, isn't it?
It is. It's a very highly charged report. It'll be interesting to see what the reaction to that is. Axios, as you mentioned, said that they will not say that Israel has been violating humanitarian law in its use of these American weapons. But it is also part of this very delicate dance between Democrats and Republicans in Congress and in U.S. politics, and also between the White House and Israel. So it's another sign of one of these things that could be a source of further tension in this relationship.
Yeah, absolutely. Thank you so much for joining us today on the show. That was Bloomberg's Bill Ferries. Also coming up, the Bank of England sending its clearest signal yet that it is closing in on interest rate cuts. We're going to hear from the Governor Andrew Bailey next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joumanna Bercetche in Dubai. Bank of England's Governor Andrew Bailey says there may be a case for cutting rates in the UK if the economy and inflation play out as expected. He spoke with us after the Monetary Policy Committee voted 7-2 to hold rates steady.
Our forecasts are conditional on a number of things, but one of the things that obviously are conditional on is we use the market curve to set them up. So I think it's important that if we find the forecast with the market curve produces a best judgment, which has inflation below target or above target, wherever, but not at target at the sort of horizon, we say so. We say this is where we got to. Best collective judgment is that. Now, it follows, I think, that, and this is the comments I made earlier, that what we're saying is if, and the if is of course critical here, if the world evolves as that forecast suggests it was, well, probably the case would be there for a less restrictive path of policy.
So is
it's
June,
all conditional.
Everything is conditional. Is June a live meeting?
All meetings are live.
There is an assumption, looking at history, that once you cut, you continue cutting. Now, without prejudging what you'll do, can you give us an idea of how you see the cycle different to 2009?
One thing I would say about this, which is sort of quite interesting, and it's something that we looked at during this round, it's quite interesting in the history of the MPC that most of the cutting cycles in inverted commas, have actually been prompted by some sort of shock or other, rather than being what I might call a natural cyclical sort of, we've reached the top and now we go down the restrictiveness curve. So we don't have a lot of, I mean, I would just caution, there isn't a lot of sort of history really to...
So what you're telling us is because you're not cutting in a recession, it could actually be one and done?
Well, I think that would be unusual, but I would say, as I said earlier, nothing's settled, there are no fait accomplis, nothing's ruled out.
The Bank of England Governor Andrew Bailey speaking to Francine Lacroix over there. Well, Bailey's remarks have left investors betting on an even chance of the central bank's first rate cut in June, with near certainty in August. Let's get out to Jane Foley, Rabobank Head of FX Strategy, joining us from London. Jane, good morning to you. Thank you so much for getting up early, especially after such an exciting day, the Bank of England day yesterday. My read of the Bank of England governor's comments is that he was quite dovish. I mean, saying things like, it is likely we will need to cut the bank rate, we will need to make policy less restrictive. All of that ties into this narrative that they have really turned quite dovish at this point, haven't they?
Well, I would certainly agree with you. I mean, even just remarking that June was not a fait accompli actually means that, well, they really are considering the possibility of a move in June, which is more than many people had anticipated, including ourselves. Now, we're still thinking August is more likely, but actually, in our views, certainly the odds of a June move have increased because of that comment. So, yes, I would agree, really quite dovish. But there was also a line of optimism, really, in the Bank of England's commentary. If you consider his GDP forecast, for instance. And if you compare that perhaps to the end of 2022, when the Bank of England was looking for a 5-quarter recession, something that didn't actually happen, the tone for the UK economy, the outlook for the UK economy looks much healthier now than it used to back then. And that is, I think, a positive medium long-term signal for the UK economy, despite the dovishness in yesterday's tone.
Yeah. Jane, but the other takeaway from central banks over the last 6 months is they still are very much data dependent. We saw how the Fed had to change tack the last couple of months. And I just wonder whether the market is once more getting ahead of themselves, because between now and June, we still have another 2 inflation reports to get to and 2 more labor market reports to get through as well. So what if those surprise to the upside?
Well, if they surprise to the upside, I think it's quite simple, and then they won't cut probably until August. So, everything is in the balance, and I think market pricing is reflecting that now. So those 2 sets of economic data that we're going to see, that Bailey pointed to, are really going to be very, very crucial. But in a way, that's how a central bank should be acting. They can't be, pre-positioning themselves for June when there is so much still at stake. So if the trend carries on, if inflation carries on coming lower, then yes, it seems likely that we will definitely have a cut, if not June, in August. But those labour market numbers to date have still been a little bit sticky. When I say that, I'm referring really to the services inflation number for the UK. That's still at 6%, which does really reflect a lot of the labour market tightness in that services sector in the UK economy. But there is a risk that labour market is now loosening, and actually that certainly numbers like vacancy per unemployed person could really start dropping quite rapidly. So those sorts of numbers are really going to show us whether or not this move is going to be in June or in August.
Yeah. Jane, can we talk about the price action yesterday? I was a bit surprised to walk in this morning and see the pound, well, cable versus USD traded firmer towards the afternoon and into the close of the session. And I wonder what you point that down to. Is it just a case of stretch positioning?
Well, I think there's a few things in that. And the first thing we've got to remember also is that initial claims data that we saw yesterday afternoon for the US. Now, that really did put September back in the frame as a possibility for the Federal Reserve to cut interest rates. So we saw the dollar softening on the back of that across almost the board. So that was something that certainly allowed cable to regain its footing yesterday afternoon. But again, if we step back and look, for instance, at sterling against the euro, yes, it is trading still above that 86 level this morning, which is outside the range that has dominated since January. But I would agree that I think sterling has held up pretty well given those dovish comments. And I think that reflects the fact that the whole outlook for the UK economy remains much firmer than it was. Again, if we step back even further and we look at the performance of sterling this year, it's the second best performing G10 currency after the dollar. Last year, it was the second best performing currency after the Swiss franc. That, I think, is because it came off very, very weak levels at the tail end of 2022. And I think over the medium term, we can carry on this very slow grind to recovery, even if the near-term picture is dominated by this interest rate differential sort of noise, if you like.
Well, end of 2022, I get a shudder down my spine remembering what happened to UK assets around then. Jane, I want to switch tack because many FX traders are keeping a close eye on what's happening with dollar-yen. I also think it's interesting there that despite the fact that the Bank of Japan did 2 rounds of interventions, we're still sitting at around 155 for dollar-yen. Why were those interventions absorbed so easily by the market, and why can't the yen rally versus the USD?
I think it's quite simple. I think the market keeps on coming back to those interest rate differentials. I mean, if you like, the initial claims data yesterday, that softening of the dollar, helped the Bank of Japan, helped the Ministry of Finance out a little bit. But at the end of the day, the market's still thinking, well, look, even if the Fed do cut interest rates in September, well, interest rate differentials are still favoring the US dollar. So we need to get either much weaker US data or much firmer Japanese data. And unfortunately, the data that we got from Japan yesterday morning, which was the real wages, was really disappointing. Now, that's exactly the sort of data that the Bank of Japan need to strengthen, because their holy grail is domestically driven inflationary pressures. And that really stems about wages, and those real wages still negative means that consumers are still going to be up against it when it comes to purchasing power.
It just seems to me that unless the Bank of Japan see the urgency to start normalizing, then we're going to stay in this holding pattern.
And I think that's probably, the observation that everybody else in the market has been making, which is why dollar-yen is right up there. So we did have some hawkish remarks, or some attempts at hawkish remarks from the Bank of Japan governor a couple of days ago. But without the strength of that domestically driven inflation data, those comments, lacked that sort of power that perhaps they need to turn the yen round. Now, there is the possibility that they could tweak their bond buying program in June. I think he has, or UADA has increased that risk now, maybe even an interest rate hike, but it's very difficult to imagine that they could hike interest rates in June without that domestic data strengthening, and I don't think we've seen that yet.
Yeah, very clear. Jane, I'm going to leave it there. Thank you so much for joining us today on the show. Jane Foley, Rabobank Head of FX Strategy. Welcome back to Horizons Middle East and Africa. I'm Joumanna Bercetche in Dubai. The Democratic Republic of Congo is a step closer to completing an IMF loan program for the first time in its history. For more, Bloomberg's Ondiro Ganga is in Kigali. And Ondiro, let me just ask you, how has the Congo economy performed over the course of the last couple of years as this IMF program has worked its way through?
Joumanna, the IMF says the economy has been generally positive. Take last year, for example, they grew by 8.3%. And this is on the back of the country becoming the world's second largest producer of copper. And so there are certain conditionalities that the IMF set, and they're being hit albeit slowly, elections being one of the things that slow down this implementation. When we also look at indicators like revenue in the first quarter, it was very positive. And also the IMF commends them for making public the contracts, mining contracts that they have with Chinese firms. And to take it a step further, the IMF says that moving forward, they would like to see oversight mechanisms put in place to ensure that this money goes into exactly what it was intended for. Once the approval process is done, $200 million is going to be disbursed to DRC, and it's meant to bolster the international reserves.
Okay, so that is the state of the economy the last couple of years. What about looking ahead? What are some of the challenges that Congo is facing? And I know that it's a very resource-dependent economy, and given the spike in some of the prices of these raw materials, that's given a bit of a boost to the economy. But what does the outlook look like?
Joumanna, Congo is a place of both potential and challenges in equal measure. If we look at challenges, first of all, security is their big issue. For the last 30 years, they've been having a civil war, 6 million people displaced, and wars are really expensive. 25% of their national budget is going into that kitty, which is forcing them to push back on investment as they try to stabilize their country. In terms of potential, they have large deposits of minerals such as copper and cobalt that are driving the EV industry. And key to IMF was them revamping some of the contracts that they have with China for the minerals for infrastructure deal. They will be getting $324 million in the revamped deal. And also, like you mentioned, when the prices of copper get to about $12,000 per ton, then they'll be getting an extra 30% of the profit, and this is to go into rebuilding of infrastructure. The goal of the IMF through this program was to make DRC more transparent, improve governance so that it can be investor-friendly. The goal here is to ensure the central bank is independent. They have an independent budgeting process so that in 4 to 5 years, they have both micro and macro stability. And so they can go to the market to borrow, they can attract investors, but most importantly, they can spend money in social issues such as education and healthcare to grow the economy.
Yeah, very important from a productivity standpoint. Bloomberg's Ondiro Ganga in Kigali. Also coming up, the U.S. poised to impose tariffs on China EVs as soon as next week. We get the details next. This is Bloomberg. This is Horizon's Middle East and Africa. Our top stories this morning. Israeli Prime Minister Benjamin Netayahu says the country is prepared to stand alone if need be, that after the U.S. withholds an arms shipment and warns of more halts. Asian stocks rising after an upbeat day on Wall Street, with U.S. jobs data supporting the case for Fed rate cuts this year. And a Bloomberg scoop. The U.S. is set to impose tariffs on Chinese EVs and strategic sectors as soon as next week. It's just gone 8:30 a.m. across the Emirates. I'm Joumanna Bercetche in Dubai. Quick market check for you. S&P broken through 5,200, closed above that level. We are about 1% now away from those all-time highs, so 0.5% higher into the close yesterday. 10-year yields also seeing a bit of a bounce after a very successful 30-year auction, coming 1 basis point through. Brent sitting above $84, trading above the 100-day moving average now, and of course getting a bit of support from the expectations that OPEC Plus won't be rolling over, or sorry, will be rolling over, rather, the production cuts. We're going to talk more about that in our next segment. And then the pound in focus after that Bank of England meeting yesterday. Some dovishness coming through. The market is sitting 50-50 on whether the Bank of England may start cutting rates at their next meeting. So something to watch out for. In terms of data, one of the big surprising pieces of data that came through yesterday were those jobless claims numbers. Big surprise. You can see that yellow print indicating that yesterday's number really was an aberration versus the 4-week moving average, telling you that that weakness in the labor market is becoming a little bit more broad-based. And that is one of the reasons why traders have started to bring forward the timing of the expectation of that first rate cut out of the Fed as well. But let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. What is on your radar?
Joumanna, on my radar, Asia stocks as they run higher after that U.S. jobless claims surge. We're seeing the Hang Seng boosted further by the financial-related stocks amid reports that the authorities could be considering a proposal to waive dividend taxes. So the likes of HKEX, China Construction Bank, those are the stocks that are seeing big gains today. But flip the board, because capping gains on the Hang Seng are your EV makers, Li Auto, BYD, and this is against the backdrop of that Bloomberg scoop that we could see EVs, batteries, solar equipment all face fresh tariffs from the Biden administration. The other auto stock that I've been keeping my eye on today has been Nissan after its operating profit guidance seen by some analysts as pretty cautious. So that could indicate that profit recovery will be slow. And in Japan as well, we're seeing SoftBank Group, that share is recouping some of yesterday's losses, which were of course sparked by those concerns related to its unit arm. Joumanna.
Avril, thank you so much. And again, U.S. stocks setting the tone for risk-on assets overnight. But one stock that we were talking about yesterday is ARM. Remember, the stock was down 10% after releasing their earnings. Well, the chip designer CEO is downplaying concerns over an AI spending slowdown. Rene Haas told Bloomberg why he's still confident in the company's long-term growth.
We're actually forecasting even higher growth this year, north of 20%. And we also signaled to the markets yesterday that in 25, 26, 27, we see that growth continuing. So we have incredible visibility to our business, and we're very, very confident of this growth rate going forward.
I want to focus in on the cell phone play, Rene, because that's been where your bread and butter has been in history. How are we looking from a smartphone perspective? Is the market looking strong to you? We've had many a mixed message coming from China demand, for example.
Overall, what we've seen in the smartphone market, particularly for ARM, has been quite a good growth rate in terms of royalties. Our version 9, which is now being used in many of the premium mobile phones, that drives a higher royalty rate for ARM. There's also more complex CPUs that go into that. That's also better for ARM. And going forward, Caroline, one of the things that we're seeing, and it's not just in smartphones, is that as these AI models are moving so fast, the hardware can't keep up with the software. The software innovation is happening so quickly that by the time the hardware is ready to run those models, everyone wishes they had more performance, they had more efficiency. So what does that mean for ARM? It's driving growth in our licensing activity. People are looking to do more and more, design chips faster and faster, and that's all good for us going forward. So I think going forward, you're going to see more and more innovation happening, not only in the smartphones, but across all these edge devices.
Rene, what's been keeping up is your valuation. Boy, I mean, do you think there's too much exuberance around AI valuations out there? Are you going to make the most of it by, well, we talked at one point of listing in the UK too?
Yeah, you know, I don't think about the valuations as much as I just think about the AI opportunity, which I frankly believe is undercalled in terms of just what it's going to mean relative to society and what it can do for our planet. I think, again, we are in very, very early days in terms of the capabilities of what this can unleash for our society. Incredibly excited to be part of it, but I don't think we're part of a hype cycle at all. I think there's a lot of innovation taking place, and you know, frankly, the innovation that's taking place and the inventions that we're seeing, it's just breathtaking. So no, I don't personally view it as a hype cycle at all.
The ARM CEO Rene Haas speaking with Bloomberg's Caroline Hyde. Bloomberg sources say President Biden's administration will unveil tariffs on Chinese EVs in key strategic sectors as soon as next week. For more on the scoop, let's bring our transport reporter in, Danny Lee. Danny, what I find really interesting about this scoop is obviously the Biden administration had been doing a review of the Section 301 tariffs imposed by the Trump administration. And for a while, people thought that they may be looking to repeal the tariffs. Instead, it sounds like not only will they keep them, but they're going to introduce new ones on new strategic sectors in China.
Yeah, it's amazing what an election year can do when you have to focus in on certain policies. So what we do know is that, yes, US President Joe Biden is about to announce sweeping measures on China tariffs. This is Biden rejecting, for example, an across-the-board hike in tariffs that is being pushed for by his Republican presidential candidate, Donald Trump. So this is Biden setting out his stall here on certain key industries he wants to target. So, for example, electric vehicles, the electric vehicle industry, batteries and solar. These are the key industries which cause a lot of concern for the US, for example, industries which China is very dominant in and could, for example, these products flood the US market, and that is fear kind of seen in Washington, and then compromise on US jobs. And so where you have these industries, these strong industries in the US, where in some of these key swing states, this is Biden trying to respond and set out his stall and show he has some kind of policy to respond to someone like Donald Trump.
Well, I mean, I remember the years, 2017, 2018, every day we'd walk in and there'd be another headline about tariffs, this tit-for-tat tariff war taking place. If these new restrictions actually do go ahead, how is China likely to respond?
Well, we've seen a flavor of China's response because Joe Biden recently announced he would increase tariffs on steel and aluminum from China. And so what we did actually get in a reaction from China was that they were clearly very displeased, they were very angry, but we haven't actually seen any specific response in terms of retaliation. We'll just have to wait and see, and that's the key thing. Wait and see what China does in response to this. Although, for example, China and aluminum imports into the US is still very, very small at the moment. But again, for China, its reaction is all important in this US political year of presidential elections.
Somehow I feel, Danny, this isn't going to be the last time we're going to be talking about this on our show. I'm sure you'll be back on to talk about tariffs once more. Danny Lee, our Asia transport reporter. Thank you. Well, we're also keeping an eye on oil. It is higher for a third day following jobs data that we've been talking about that supported the case for U.S. rate cuts this year. Those surprising spike in jobless claims, the figure that came out yesterday, put a bit of a dampener on dollar. But obviously that was good for the commodities complex, as we're seeing with the oil figures up on screen. Let's bring in Stephen Straczynski, our senior energy reporter, for more on this. So the last couple of days, we are seeing oil prices start to climb a bit higher. I've been mentioning that 100-day moving average, we're above it now, $84. What do you think the catalyst is? And is it mainly geopolitics?
Yeah, I mean, I think there are a few things. When we take a step further back beyond just this last few days to the last few weeks, we have sort of seen a downtrend in oil prices when there was an unprecedented attack by Iran on Israel. We did see oil jump above, for Brent, $90 per barrel, and it kind of peaked there as the geopolitical fears started to de-escalate. I mean, I think there is still a risk premium in oil prices, but they kind of had been falling, and now we're in the comfortable, mid $80 barrel for Brent range. The last few days, it's been driven somewhat by fundamentals as well as just monetary policy. As you mentioned, the higher likelihood of the Fed reducing interest rates means that it's also putting some downward pressure on the dollar, and if that happens, it adds appetite to risk assets like oil. So, you're probably seeing some sort of flow there. Of course, going forward, what is happening in the Middle East is going to be highly watched, especially as people figure out exactly how Israel is going to deal with the current conflict with Hamas.
Yeah, and we've got the all-important OPEC Plus meeting coming up in a couple of weeks' time. I'm actually going to be in Vienna covering it, so maybe you can give me a little bit of insight on what's going to happen there. I feel from reading all this market commentary, June 1st is the day, but reading all this market commentary, it doesn't feel like anyone out there thinks that there's going to be any change on these output production targets.
Yeah, no, it looks like we're going to be seeing a continuation of the cuts. It's exciting that you're going. I've never been. I want to go. So maybe tell me what it's like after you go. But yes, we're going to see an extension of the cuts, probably at the current levels because of that weakness in the market, right? Like if we were talking about a $100 barrel again, we would probably be saying, okay, well, maybe OPEC Plus will add those barrels back to the market. Saudi Arabia will be eager. But when we're talking like $84, potentially $80 Brent, the OPEC Plus is absolutely comfortable to continue those cuts. Maybe say, hey, Iraq or other members, let's kind of make sure we're hitting those targets, because you sometimes haven't really done that. So that's likely what we're going to hear. We have seen the banks and some analysts saying that there is a chance of maybe a modest increase, which would be bearish for oil prices. But I think we are likely going to see an extension into a third quarter of production cuts, which will add sort of a floor for the oil market. I don't think we're going to see a spike in prices, as like what you said, it is widely expected, but it will continue kind of leaving us in this 80 to 90 range for Brent, which I'm sure Saudi Arabia is pretty comfortable with.
Yeah, and I saw in a Goldman note yesterday, they called that increasingly bearish fundamentals. So there you have it. Lots of people are talking about the backdrop as well. Stephen, thank you so much. Great to compare notes with you about the upcoming OPEC meeting. Stephen Savinsky, our senior energy reporter. Also coming up, a rare Dubai private sector debut. We'll look at why Spinny's shares didn't pop as much as other recent listings. That discussion coming up next. This is Horizons, Middle East and Africa. Welcome back to Horizons Middle East and Africa. I'm Joumanna Bercetche in Dubai. Let's turn to Middle East markets. Here in Dubai, high-end supermarket chain Spinny's rose as much as 11% in its trading debut after a rare private sector IPO. For more, our equities reporter Farah Al-Bahrawi is with us. And I can see we've got the screen up, Farah, that by the end of the day, the stock was up 4.5%, which is good, obviously, but in the context of other listings that have hit the UAE market, I would say it is slightly underwhelming.
That's exactly it, Joumanna. So for Spinny's, they did rise as much as 11%, but looking at the closing price, it pales in comparison to the 37% pop we usually get with UAE listings, at least over the last 12 months. I would say that this is still a positive sign for private companies to come to the market and list, because it did get a lot of demand. And you know, in the end, it did close a little bit higher, but investors here have become accustomed to that really large rally on the first day of trading, mostly because a lot of these companies that go public are government-backed. So the government is able to leave a little bit more on the table for investors to snap them up and trade it.
Yeah, that's such a good point. So the fact that they are government-owned means they're quite happy, really, for the private sector to get those good prices when they buy into the IPO. Very good perspective. Yesterday on the show, we had Yvonne Mann talking about the interview that she did with the head of Tadawul Stock Exchange. Really interesting commentary there. And I guess it's interesting to look at it within the context of the IPO scene in the region. I know Saudi Arabia have been actively trying to court investors out in Asia. What are some of the upcoming listings you're watching out for?
Exactly. The CEO yesterday showed very clear optimism. We have north of 60 companies eventually or possibly coming to the market in Saudi Arabia. Some of the highlights would be Fakih, which is set to be Saudi Arabia's biggest listing so far this year. They're expected to price at the top end of the range because investors are risk missing out on anything below that, according to terms that we've seen. We also have Saudi Manpower Solutions, planning to raise as much as 900 million riyals. Again, not a small listing coming to the market in Saudi Arabia, as well as Miyahuna, another one pricing at the top end of the range. So the demand is not just there from companies that want to go public, but it is coming from investors. What's interesting is that we're also seeing various sectors and various companies in terms of the business cycle, whether they're small, whether they're big, coming to the market as well.
Yeah, so earlier this week, I spoke to the CEO of NASDAQ, Irina Friedman, and she was saying what a healthy listing environment she's seen and she's witnessing right now within the UAE and Saudi. And to her point, she was saying there were more listings in Dubai for last year, the calendar year, than the entire year for NASDAQ. So something for international investors to keep an eye on as well. Farah, thank you for bringing us the latest, our equities reporter. Now, let's get to some other stories we're watching as well. Bloomberg has learned that HSBC and Standard Chartered are among major UK firms pressing Prime Minister Rishi Sunak to tone down proposed restrictions on doing business with China. Sources say the banks are lobbying ministers not to include China in the strictest risk category in new national security legislation. They argue this would impede business and trigger negative publicity. Goldman Sachs has led major investment banks in posting higher profits in Japan. Net income at its local securities arm rose by a quarter last year to around $250 million as fixed income trading gains doubled. The figure marked the highest earnings in 14 years for Goldman Sachs. And Bloomberg has learned that Apple plans to push many new AI tools across its devices through data centers using its own chips. Sources say high-end M2 Ultra chips will be deployed in cloud computing servers designed to process the most complicated AI tasks. Apple is expected to lay out its ambitious AI strategy in June. Meanwhile, Apple has issued a rare apology over an online ad for its latest iPad Pro. The images of musical instruments, TVs, paint cans, and other creative tools being crushed into an iPad sparked a furious online backlash. Among the critics is actor Hugh Grant, who says the ad promotes the destruction of the human experience. Apple now won't air the promo on television as planned. Well, this is a discussion that we've been having here around the set. Were Apple right to issue this rare apology? At the end of the day, they are a tech company, and that's what tech companies do. They introduce innovation, they disrupt. So where do you stand? Do you think Apple owe the viewers an apology, or are you in team of, at the end of the day, this is a tech company doing what tech companies do? Let us know. We want to hear your views. All right, also coming up on our show, as Turkey's central bank raises its inflation outlook, the government is looking for ways to save money. We're in Ankara coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joumanna Bercetche in Dubai. Turkish officials are said to be planning to announce new fiscal measures to tackle soaring inflation as early as next week. Bloomberg understands the government's savings plans will include cuts in public spending. Let's bring in Bloomberg economist Selva Bahar-Raziki, who is in Ankara. And maybe let's just start with these potential plans to be unveiled by the government. What do we expect, and how much of an impact are they actually going to have on these inflation figures?
Morning, Joumanna. Actually, the fiscal side usually is talking about investment cuts. We don't know the perfect details of the announcement that's coming next week, but considering how these are long-term investments, it's likely to not have that much of a large, sizable effect on this year's figures. The central bank has released quite optimistic forecast for year-end at 38% for this year. We see it at an elevated 43, and our statistical model actually sees 1 in 5 chance for inflation to land between 40 and 35, where the central bank's estimates lie. Now, most of the difference between our estimate and the central bank is actually due to fiscal side, but again, as I said, the assumptions are not on investment, and those take a long time to show up on inflation, especially in the short term.
Yeah, I mean, these are still really high numbers. We're talking about the Bank of England yesterday of service inflation running really high at 6%. Turkey, we're still talking about close to 40% right now. Inflation is at 70%. Really difficult to comprehend what that actually means in practice. But what is the implication for monetary policy? At the end of the day, it just means that they will have no option but to keep things restrictive.
That's right. But the fashion in which they will do that is actually going to be quite unique to the domestic pressures. We think that the central bank is actually done hiking, so no rate hikes coming up ahead. But still, financial conditions will be tightened, and that's going to arrive in 2 legs. One, the central bank is going to actively use its interest rate corridor, shifting funding away from its main repo window to the overnight lending, where the interest rate actually lies 300 basis points above the official policy rate. The second leg is going to be an avenue that the central bank has frequented quite often recently, and that's using alternative tools such as the reserve requirements, credit growth caps, and as well as banking regulation to steer banks into providing lenders and also depositors higher interest rates and thereby tightening financial conditions.
Ultimately, that is a goal, but as ever, the question is what sort of an impact it's going to have on growth. So we'll save that for our next discussion. Bloomberg economist Salva Bahar-Raziki, thank you for joining us. A quick look at markets before we head out for the day and for the week, the end of our inaugural week of Bloomberg Horizons. All of the majors are seen opening up in positive territory, S&P through 5,200. That was the key line. But that is it for Horizons Middle East and Africa, our last show of the week, but our first week of many. I'm Joumanna Bercetche in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.